Hey everyone, welcome to Fundamentals Unfiltered. I'm Matt with the Fundamental Investing Institute. We are recording this on Tuesday, October 14th, 2025. So I'm going to start by addressing an interview that was given with Barron's in the weekend edition with Kevin Warsh. If you don't know who Kevin Warsh is, he is one of the three top candidates. Well, I'm not even sure if it's three anymore. It might be five, but one of the 3 to 5 top candidates to replace Jerome Powell in May of 2026. Powell's term as chairman of the Federal Reserve is up, and he is definitely going to be replaced with someone. Warsh is one of the candidates. Warsh is interesting in part because of the main candidates. He seems to be the one who's been the most vocal in his criticism, specific criticism of the Federal Reserve. And also he has probably articulated his vision of what the Fed should look at. Warsh was a former Fed governor. He was a Fed governor around the time during the financial crisis. At the time, he was very young. He was the youngest Fed governor. I think he was 35 when he first became a Fed governor, and he served until, I don't know, maybe 2010, 2011. He's been working with very famous former hedge fund manager named Stan Druckenmiller. Druckenmiller now just manages his own money, his billions of dollars, and Kevin Warsh works with him. Warsh is very well pedigreed, Ivy League education, served at the Fed. He's been in high finance for a long time. He's been in the macroeconomy since then. In addition to working with Druckenmiller, he has been working with a number of think tanks. So anyway, he's really articulated his views, and it was a very interesting article. And I'm just going to address a couple of things because, first of all, he tells an apocryphal story of running into Paul Volcker. Volcker was the chairman of the Federal Reserve in the early 1980s. He was the one who was most responsible for bringing down inflation, doing so through a very, very tight monetary policy for a few years, but it broke the back of inflation and it restored the Fed's inflation-fighting credibility. And Warsh tells this story of Volcker saying, the job of the central bank is to do two things: get interest rates about right, and make sure you look like you know what you're doing. So Volcker passed away a few years ago. I think he was 90 or 91, but he was as much as he was villainized at the time, when he left the Fed, he was very much lionized as the person who kind of broke the back of inflation, the late 1970s inflation. But that's an interesting story. But what Warsh is really talking about is, in his view, the Fed has really lost its inflation-fighting credibility. I don't think this is a huge problem given where interest rates are, but Warsh is attributing to the higher interest rates to a lack of inflation-fighting credibility. There's certainly a case for that. In 2020, the Fed had a very flawed operating framework that they rolled out, where they were going to let inflation run higher for longer, and that certainly had a lot to do with the inflation that we saw over the subsequent years, and then the Fed having to catch up, and we had this interest rate shock. So certainly there's a very valid argument in his criticism of inflation fighting credibility. To his view, the Fed should really focus on two things: de-emphasizing, he said he wants to de-emphasize the inflationary impact of factors such as supply chains and tariffs, and focus on government spending and the money supply. So this is very much what we would call a monetarist view. Monetarism means a lot of things, and there are a lot of different variations of it, but it all really comes down to emphasizing the money supply, and Warsh would maybe bring that back in focus in ways that the current Fed is not doing. Whether that's justified or not, I don't know, but that's something that he's talked about. And it really comes down a lot to what's called quantitative easing. A big part of Warsh's criticism is that the lines between fiscal policy and monetary policy have been blurred. So if you don't know what quantitative easing is, back in 2008, the Federal Reserve started to buy assets they wouldn't normally buy. So before the financial crisis in 2008, when the Fed engaged in what are called open market operations, they would buy short-term treasury bills from a number of what are called primary dealers. And when they bought these short-term treasury bills, they would pay for it by increasing reserves of those primary dealers. And so they would increase reserves in the banking system, and then when they would sell treasury bills, they would decrease reserves in the banking system. And it was with this manipulation, I guess for lack of a better way to put it, of the supply of bank reserves, they can influence interest rates and credit conditions. But they always bought and sold bills. It was called bills only policy. In 2008, they expanded that in response to the financial crisis and what came to be called quantitative easing. So they were buying a lot of longer term treasury debt. They were buying a lot of mortgage-backed securities. And of course, this was both to enhance liquidity in the mortgage market at a time when that market had really collapsed. And it was also a way to just introduce a lot of liquidity into the banking system in a way to stabilize the system. Now, the Federal Reserve did this. The European Central Bank later did this. The Bank of Japan had been doing this kind of thing for many years. In fact, that was really the precedent for what the Fed later did. It came from the Bank of Japan. And then the Bank of England did it, and other global central banks have done it as well. And so we're starting to see a backlash against this because these assets are still on the Federal Reserve's balance sheet. And it raises a lot of questions. The Federal Reserve, and not just the Federal Reserve, again, global central banks are doing this as well. And what Warsh is saying, and a lot of other people are saying, is that the lines between fiscal and monetary policy have been kind of blurred because the Federal Reserve has, when they were buying these assets, maybe fiscal policy was looser than it would have been otherwise because that liquidity is there. So I do think an emphasis on government deficits needs to be brought into the monetary policy discussion. But one fear is the Fed started tapering their purchases a number of years ago, and they started to shrink the balance sheet, really starting in 2022. But if they do this in any significant way, it's going to have impact on credit markets. It's going to have impact on interest rates. It's going to be, a flood of supply of these securities that's coming in, and it's not sure whether the supply can be absorbed without huge interest rate shocks. So it's one thing to consider, but it was interesting because of the major candidates to replace Jay Powell, Warsh is at least being, I think, the most transparent in his thinking, and that's certainly good. So as we come into the new year, we're the last quarter of the year. As we come into the new year, there's going to be a lot more discussion on the direction of the Federal Reserve, and I'm sure online somewhere there's probably some betting markets on who is the most likely to take over. I don't know how much weight anyone wants to give to that, but I'm sure there's people talking about it. So the candidates that I know: Kevin Warsh, Christopher Waller, I think his name's Waller, who is a current Fed governor, and then Kevin Hassett, who is the head of the National Economics Council. Those have been the three candidates, and then I heard recently I can't remember the man's name, but the head of fixed income at BlackRock. BlackRock is a huge money manager with, I think they have almost $14 trillion in assets under management. But the head of fixed income there is another name that's been brought up. So we'll see. I mean, I'm not gonna guess on who's going to take over, but it is very likely that whoever becomes the next Fed chairman is going to take the Federal Reserve in a little bit of a different direction. And given the impact that that's going to have on broader credit markets, is something that everyone needs to take to really pay attention to. So take that for what it is. But one thing that I want to talk about today a little deeper is gold prices, because I did not look at prices this morning, but as of yesterday, the 13th, spot gold is gold that is settled for immediate delivery, and then gold futures, which are contracts that are settled for delivery of gold at some point in the future. Both spot gold and gold futures broke $4,100. Gold has just been on a tear, and so there is a lot of discussion as to what is driving the rally. One view is gold is just this catch-all hedge against inflation, against government deficits, against imbalances in the global economy. It's just this, it's this hard asset that's always been the store of value for people during times of uncertainty. And the other view is that some of it is just becoming a momentum trade. The scary thing about it becoming more of a momentum trade is momentum works both ways, right? So momentum is psychological in nature. People buy an asset because they have fear of missing out. They think it's going to continue to go up. They don't want to miss the party. They don't want to miss the gains. But that same psychology can reverse. And when it hits on the downside, people tend to sell en masse because they think that prices are going to continue to go down, so everyone rushes to the exit at the same time. Historically, big run-ups in gold have been followed by pretty significant crashes. The early 80s was a prime example. So gold was very much an inflation hedge in the inflationary 70s and early 80s, but when the Federal Reserve really brought inflation under control, what's called the Volcker disinflation, gold prices crashed pretty significantly. So this is a big concern. Now, a couple of articles about the so-called debasement trade, right? So that term debasement really comes from the days of old when coinage was the primary currency, and what governments would do is they would reduce the metallic content of the coinage. So they would they would replace it with a lower valued metal, or they would reduce the size of the coins. That term debasement could also go for times of the International Gold Standard, when gold was convertible to dollars and other currencies, and maybe gold prices, again, the metallic value of that paper currency could go down. That's where the term debasement comes from. But now it just means general inflation. And so one argument is that a lot of people expect prices to go up, and one of the problems with that idea of gold as primarily a debasement trade is we're not seeing that in interest rates. If inflation expectations were in fact surging, the yield on the 10-year and the yield on the 30-year would have reflected that. But year to date, both of those yields have been trading within a relatively tight range. I think the 10 years, traded between 4% and 4.5% on the high side, and then the 30 years been trading around 4.5% on the low side and closer to 5% on the high side. But it's really been traded within that range. And if inflation expectations are going up significantly, you'd see that in interest rates. So that's certainly, I don't doubt that gold is being bought as a debasement trade to an extent, but it's certainly not the only factor. Another thing that we have to keep in mind is a lot of global central banks have been buying gold for a long time, and the World Gold Council, one of the articles, this is one that actually came out. This one that actually came out this morning. Let me see if I can find it. How long will gold mania last? This is a big read in the Financial Times, but they quote the World Gold Council, and based on their estimates of what global central banks hold in terms of gold quantities, when you multiply that by the current gold prices, it looks like now global central banks have more gold assets than they have in dollar assets. Not by much, but shortly higher. And maybe that continues. Maybe global central banks continue to buy gold as an alternative store of value. But one concern that I would have, and in the interest of disclosure, I don't own gold, but one concern that I would have is, what if global central banks start to sell off those holdings simply because it's becoming such a large part of their portfolios? That's something that I would be concerned about. In addition to the possible momentum of this, we also know a lot of more and more retail investors are getting involved, and that always seems to be, kind of the tail end of things. I hate to say that, but when more retail investors jump in, and institutional investors might be pulling back, that's usually the sign of a late cycle. And the other thing that I would be concerned about is, frankly, if gold is the catch-all hedge, some of the things that gold is hedging against, if governments actually get their act together, restoring the inflation fighting credibility, if they're able to embrace fiscal discipline, which I don't see happening right away in the United States, but it may. So if these various things that gold is supposed to be a hedge against, if governments actually get their act together, then obviously that hedge is less attractive. So point is, there's a lot to be nervous about looking at gold prices, but like I said, a lot of smart market commentators and traders are really trying to figure out, to what extent is this just a hedge? To what extent are those global uncertainties, going to continue, in which gold prices would continue to be attractive? Gold would continue to be attractive as a hedge, and there are some smart people arguing for that. I know Ray Dalio, the former hedge fund manager, has talked about gold as being increasingly looked at as a alternative store of value. Ken Griffin, who runs Citadel Securities, he's as in tune in the global markets as anybody. He's talked about gold as an alternative store of value. Lots of other people are doing that as well. Is that the case, or is this primarily a momentum trade? And if it is a momentum trade, then I think anyone holding gold is going to have to be concerned about that momentum trade, the trajectory reversing course. So, just things that I would be nervous about. Again, I don't own gold. I follow gold prices because I think it's a very important macroeconomic indicator. I think it shows a lot of uncertainty about fiat currencies, not just in the United States, but in other economies. I think it shows you a lot of uncertainty about, things like government spending, government deficits. So gold is an important variable that I follow, but I don't directly own it. But I would certainly be nervous if I did at these run-ups. We should probably note silver is, I think year to date, silver is doing even better than gold. And that is something I've owned a little bit of, but really kind of an immaterial amount, relatively speaking. But it's interesting because, again, you are kind of seeing, you are kind of seeing people flee dollar assets into these hard assets. And how long that continues is anybody's guess. So I do not have a book this week. I've been talking about books that I'm in the middle of reading. The book that I'm going to mention is a book that should be coming in the mail today. It's a book by Andrew Ross Sorkin on the 1929 stock market crash. If you don't know who Andrew Ross Sorkin is, he's a business journalist. Probably one of the preeminent business journalists today, and he is he wrote a great book on the financial crisis called Too Big to Fail, and it was about the collapse of Lehman Brothers. I think it was made into a movie. I think it was made into a movie for HBO, maybe. I don't know. Didn't see it. I know Paul Giamatti played Ben Bernanke, but I didn't see the movie. But in any event, so he wrote this great book on the financial crisis. He's now written a book on the 1929 crash. That comes out today, the 14th. And I will be checking my mail with interest because that should be coming in. I pre-ordered that from Amazon, and I'm looking forward to reading it. So I will comment on that when I can. I am in the middle of a very big project on the global economy. We're producing a number of videos and also have a Substack where we're going to be documenting that process. So I've got 30 books that I'm reading as part of that process, and hopefully I can squeeze in Sorkin's book somewhere in there because if nothing else, I'm definitely a student of financial crises, and this is a book that I think is going to be an important contribution to that literature. So I look forward to it. But I am in this deep dive on the global economy, and if you can check out our other videos, because like I said, we're going to be documenting that process, the books as I go through them and my thoughts on them, and I think it'll be very important for investors. One of the things I'm trying to do with the Fundamental Investing Institute is I'm trying to get beyond just the basic blocking and tackling. So even though we're developing a lot of educational content on how to read financial statements, calculate valuation ratios, things like that, I'm really trying to be more thoughtful on macroeconomic context, on studying different industries and things, on how to make better decisions. So it's all these things that kind of at the margin that will make people better, I think more thoughtful investors, and that's what we're really trying to make a unique contribution. So this one is on the global economy, where I'm looking at both the kind of textbook arguments in favor of global economic integration, but also very much looking at the human costs, looking at the political realities, and trying to educate myself, but also sharing that journey with all of our viewers. So I will be focusing a lot on that, but like I said, hopefully I can get Sorkin's book in there and I can provide some commentary on that. With that said, hope everybody has a great week and best of luck in your investing endeavors. As always, focus on the fundamentals.